what would you tell someone who is trying to achieve financial independence? Do you have any advice for them?
For financial independence and the retire early aspect, those are obviously two separate items. I think living below your means, delaying gratification, saving as much as possible. Even the experts say 15% of your gross income. Well, that's if you want to retire at 65, you're fine. If you want to retire earlier or do a hobby for the rest of your life, then you need to save more. And most people don't even do the 15%. I think the Canadian average is like 5 or 6. Like it's not even 15. And of course, starting investing. Take some educated risks when you're investing. If you don't trust yourself to invest in a lump sum, then do it every month using dollar cost averaging and do the pay yourself first. How much you get to invest depends on the combination of income minus expenses. So you need to increase your income or decrease your expenses. Your choice. And if you can do both, great. Avoid lifestyle creep as you get a raise. Don't think that you're now rich and you deserve a better lifestyle. You can always outspend whatever income you have. Guaranteed. Educate yourself about investing and personal finance. They're very important topics. I'm sure every teacher, going back to that, thinks that whatever they're teaching is super important. But I think finance can change your life. Read a few basic books, become interested. I have friends who research their next truck or their next TV for hours, days, and then they go to a random financial advisor who's at the branch on a Saturday morning, and they give them their money, and they just do it blindly. And they're like, yeah, that mutual fund sounds good, sure. And then for financial independence, I think maybe the most important is to have multiple streams of income. So have your dividends, have your rents. If you're actively working, have your active work income, capital gains from trading, if that's what you're doing. If you, as you said, if you want to do training videos, ebooks, everybody has a book in them, I heard. You can't stop working if your job is your only source of income. Like a lot of people are screwed if they get laid off after a couple of months. Their savings are gone. And if you have multiple streams of income, you're like, great, I'm going to jack up one of the side hustles and off I go. And I'll still look for a job. It's not going to land me on the street. So multiple sources of income, I think, would be the biggest piece of advice. So what about you?
I think you hit a lot of my points as well.
Sorry.
It's pretty much like a broken record. Like most of us who have studied this topic, those 10, 20 points is all the same. It's just worded differently by different people, but it's all based on the same type of principle. So just make sure you make more, save less. And by saving, I don't mean like saving as in putting it into like a tax-free savings account and just parking it there. I know some people actually do that.
Yeah,
they say it's labeled the savings account, so I put my savings there. I'm like, what are you doing? I just want to slap them, but then I can't really teach them. And then I advise them to invest in something. It's like, oh, but it could go down. Okay, but it can also go up. But then look at the outside. It's just like, oh, but it can go down. Great. So make more, save less. I think both of these parameters you can control. Like making more, like not just from your primary job. You can always look for side hustles, like find something on Craigslist, resell it on eBay. Just try different things. Like there are so many side hustles. You go on YouTube, people say like there's 20 side hustles in year 2020. Look through a couple of them. Like some of them are ridiculous. You just watch videos and click on videos all day and then you make some money. I don't advise you to do that. But there are a lot of good ones. I implemented, if I think of my revenue streams, I've probably done 20, 30 different avenues of income. And I can probably make videos out of that too. Living below your means, build your snowball at an early age, even with $50 or $100, because there are brokerages with free commission right now. You can just buy a fractional share even. If you like Apple is 150, 100 right now. Yeah. That's US dollars, but you can buy fractional. You can buy half a share of Apple. Start, because once you start, you kind of pay more attention to it. And therefore, you're more aware of the market and how this investment game works. Winning or losing. Winning, okay, so next year, this Apple stock has grown 15%. Like, why did this happen? Like, what triggered all this? Like, is it just random? Or what if I bought like a wheat stock and it went down 50%? Like, why did that happen? Or why was I persuaded to buy the stock? Like, you have to understand why you make certain actions. And it's better to know early, because in the early stage, you're starting with like $100,000. But in the later stages, you're putting in 10,000, 50,000, and you're losing a lot more. It's better to learn these lessons at a much earlier age. So I think that's the basis of like my advice.
Yeah, to be fair though, I think a lot of people actually aren't interested in stock analysis. I think it's difficult. You're often wrong, so you're not really getting the positive reinforcement. I think most people are okay with an exchange traded fund or a mutual fund, but you have to get the right ones. You have to get good ones. Individual stock analysis, I think, is for people who enjoy it, and even then, I think they should have a significant amount of their portfolio in diversified mutual funds or ETFs. I mean, education, I think, is the most important. I do get that, you come home from work after 8 hours at work or more, you probably commuted 45 minutes each way, and you want to eat and you want to play with your kids. To go on the computer and research stocks is probably, even if you to enjoy it, that's probably not your primary thing. So I do get that. I like, even an index ETF would be fine. You'd still be making that 7, 8, 9%.
Yep, that's fine.
You'd be okay.
With a lot of investments, let's say your mutual funds, or if you talk to a financial advisor, always look at the MER or the fees that they charge. Like, there are upfront fees, there are running costs, there's like loading fees. There's just so many fees they can throw at you. Like, whenever you see fees in the word, just like ask questions. Like, these are red flags. Don't just like assume that's the norm of things. Like, the norm is Vanguard, is where the fees are 0.03% or 0.1%, not 1.2%. There are some good funds that do charge 1%, but they must be like premium stuff with like 10-year track record and just outperforms the index like through and through.
Yeah, absolutely. The fees eat away at the performance. So, and over many years, it will make a very significant difference. So you should be aware of the fees. The performance that you would see on any of the research sites is obviously after the fees come off. So you should be looking for performance, but the fees definitely subtract from performance. People don't realize it. They don't know about the fees. There's thankfully a lot more disclosure these days, which was mandated by government. They've had kind of incremental disclosures, and so now your financial advisor has to let you know by letter, it's in your statements, how much they got from you. Back 20 years ago when I started investing, I didn't know. And that taboo of talking about money is if I thought I would ask a financial advisor, how much do you get paid? How do you get paid? I thought, it's like asking him about his salary, right? That's not polite. But it's all coming out of my pocket. So I should definitely know and make sure that I'm okay with it. Just awareness, right? Like I know everybody has something. Like somebody loves working on their car. Like if I were to have a car, I'd be like, no, it's dirty under the hood. I'm not reaching in there. So, everybody has their thing that they enjoy, but also everybody should know at least a little bit about everything. Like I know how to change the oil on a car. I know how to change a tire. Everybody should know a little bit, at least so somebody doesn't take advantage of you.
Yes.
So, and the same extends to investing. You don't have to be trading options. You don't have to be selling stocks or buying stocks, but you should know enough that in 40 years you'll have a comfortable retirement.
By like knowing and researching, I think there's like a stat that says if you ever just read just three books on a certain topic, you know more than 95% of the people about that subject. You should like print this out and put it on a wall somewhere. Like just read 3 books on finance and then you're good for life. And you can probably teach your kids that too. That's it. Like $3, a buck a week, a buck a month, whatever. Spend 3 months on it. It's
Yeah.
worthwhile.
Read the Wealthy Barber.
Yep, that's a good one.
That's you go.
I got all of them here. Here's your Wealthy Barber, and then Rich Dad Poor Dad is a good one.
The book looks brand new. I don't see any dog-eared pages or anything.
Oh,
What? Yeah, shiny. What up with that?
Well, that's for YouTube display only. Like my other collection is in your library right there.
The display model. That's right.
Yeah.
Just learn some of the basics, right? I think that's all I would suggest to anybody. And if you want to retire early, absolutely.
Remember that slow and steady wins the race. It's okay to chase like shiny objects, like the home run plays, like the Teslas or certain weed stock. It's okay to chase it once in a while, but you got to be mindful of like how much your wager is. You wouldn't go 100% on it. Like everyone's risk tolerance is different, but risk a little bit. Take 1% risk. Take a couple $100 and just take these home run plays. It might be your thing. Like if you find that over like 2, 3, 5 year run that this is the way that like really makes you gains, and you can allocate more assets into that sector. But diversification is always key. Like people say dividend stocks, and then your growth stocks should be like much less than your dividend stocks. But it really depends on the person. For me, it could be 50-50. It's just what you're comfortable with. But then you need to start investing to know what you're comfortable with. Some people invest way too late that they just follow someone's path, and then they go to a financial advisor, they tell them exactly what to do, and then they charge you a hefty fee. Like that's what you're paying them to do, to find out your whole financial journey, where everyone and anyone can do it themselves. Like it doesn't take that much time or money. Just start slow, as I mentioned before. Start with $100, one share of an index fund, one share of their favorite conglomerate, Coca-Cola or McDonald's. Like one share of anything. Just open a brokerage account, put your savings into that account, and start investing, instead of putting it in a piggy bank or a TFSA account. It's just ridiculous to me, but the TFSA account and what they do with it, and how the banks don't tell you can invest in that portfolio and what the benefits are.
I was watching an online conference, and there was a gentleman presenting. It was, I think, Canadian version of, usually they're US, but this one was Canadian. And it was a gentleman presenting who was billed as contributing and creating the TFSA. He's like, oh, okay, this guy must know what he's doing if he created the TFSA. I'm like, I think he's screwed so many millions of Canadians by calling it savings account, because now everybody has returns of 0.5% on their TFSA or less. I'm like, I'm not listening to this guy.
That's what not to do.
Like, he just screwed it up for so many people for 10 years plus, however long it's been around. I was going to ask you, can you summarize kind of how your progression in investing vehicles was? For example, mutual fund, stocks, options. What was kind of your progression? How did you go?
I'm very different. I started with individual stocks. The first stock I bought like 15 years ago was Apple. Okay. And I learned a lesson there as well, that if I held on forever, like you find like something good and you hold on forever. But I got out of the trade maybe when it like tripled in value. And like once I got a couple of these like returns from individual stocks, I just kept targeting individual stocks. And eventually I moved on to options, where I know that if I'm right, I can, instead of get the 300%, like the 3x on the Apple, if I made the same play over the long run, I would have made 10x, 15x. But these are home run plays, and I know exactly how much risk is involved. And then eventually I moved on to options on the other side, where I sell these option contracts for like premiums. So in my mind, these are the dividends that I collect. I never touched dividend stocks more than 5 years ago. I never thought about it because I wanted the growth. I wanted I wanted the 3x, I wanted the 5x or whatever, because that shortens my time of horizon of investing. Over time, when you start gaining a little bit more, I have that waterfall analogy again. So you take some off, you say you take 50% off, and then you put some in the dividends basket, you put some in the all weather baskets. That's just to like diversify your risk. That was my run. And just recently I got into that bond and gold just because of the all weather portfolio, or else I wouldn't touch it in my early stage. I mean,
I think most people usually start out with mutual funds because that's what people at the branch, the financial advisors give you. And they might stick to them for the rest of their lives. I think these days, maybe people could start with ETFs if they go out and do it themselves without a financial advisor. Then maybe people move on to stocks and options are, I don't know. I don't think very many people start with them.
No. I didn't start with them either. I believe options like level 5. And investing in like index funds like level 1. So you definitely need to build up your risk tolerance and how you handle losses before you touch options, I think.
Yeah, but I think because of the internet and all this information being out there, I think maybe people get into options and
way too early.
They didn't really build up to it with stocks but yeah, you also have to be, I think, smart about it and have 70-80% of your portfolio in something diversified. Yeah. And then you can play with the rest if that's what floats your boat. I met some day traders. Through meetup.com, I went on there and they were all kind of college kids. They were all coming from classes, going to the meetup while I'm coming from work. But yeah, they were day traders. They were day traders. They all got up at 5:30 in the morning, checked things, pre-market trading, and then
emphasize things. What exactly are they checking?
I don't know. At 5:30, I'm not coherent. I don't know about living on the West Coast if you want to be a day trader on Toronto or New York. Yeah. But I guess everybody kind of has their own thing, which you kind of gravitate to. Like, for example, I haven't touched any futures, and I've never bought options. I've sold options, like 36 and counting, I think. But because like I'm the dividend person, right? So yes. Options are income. So it's kind of interesting how different people maybe you fall into it by accident and you just sort of learn, but everybody has to kind of find the vehicle that they're most comfortable with. And the other thing is like about 40% of my portfolio is mutual funds. Other than once every 2-3 months, I check that there's still 5 stars on Morningstar. Nothing. I don't do anything with them. The stocks, ETFs. Okay, let's see how they're moving. See if we want to buy more, see if we want to sell some. So a lot more hands-on, I guess, right? With options, I guess if I were buying them, it'd be a different story, but selling them, I'd just like, okay, do I need to buy the stock or is it going to be called away? So it's a lot simpler from that perspective. A lot of what I've done is because I've had goals, and I've been single-minded about them. I track my expenses, and so I know, for example, that when I'm working, I'm living on like 12 to 15% of my income. That's just me. Not everybody wants to live that way. I don't have a car. I'm not really a traveler because I'm afraid of flying. Being single, no dependents, no hungry mouths to feed, and also I get to make all these decisions for myself. Right, it's not like I have a family. I'm like, we're living like paupers. It's like I don't need to make that decision for anybody else. But I think if somebody had kids and you had both the partners, both the parents were on the same page, 2 incomes, you could still get financially independent even with kids. But kids are expensive. $250,000 from birth to 18 without even including cost of college seems to be kind of the going rate. That's a bit
pricey. It's pricey, yeah.
That's like $15,000 a year Both the spouses, by the way, would have to be on the same page. You can't have one person trying to be frugal and going for financial independence, and the other one going, "We more money to spend for me."
More for me.
That's kind of a tough thing. If one of the people says, "Okay, I don't want to do my job anymore. I need to quit." That's sort of a change in plans, right? So if you kind of married each other with the expectation that you're going to have fun and you're going to save 15%, and now this person says, "Okay, I can't work for another 30 years till I'm 65, like I need to quit," then that's definitely a conversation in which the other person might say, no, I don't want to live like that. So that's kind of tough. I use the phrase decisions have been made. You have to make your decision and stick to it, decide how you want to live and what your goals are. As the saying goes, you can either look rich or be rich. Few of us live long enough to do both. That's a quote from somebody that I can't remember. Stop trying to impress people and just be comfortable with who you are. Other bits and pieces would be track your revenues, your expenses, so you kind of know how much money's coming in, how much is going out, know your net worth at any time. It's pretty motivating to kind of watch it go up. Because I'm incorporated, I'm not paying into the Canada pension plan, but that's a decision that if you have a permanent job, you can't really avoid it. But because I'm self-employed, my corporation would be paying half of the CPP and I would be paying the other half of the CPP. While if you're working for somebody else, you're only paying half that they're pulling out of your paycheck. So that was why I stopped doing the CPP thing. And for a lot of people, it's just kind of a forced savings vehicle. My accountant says that, of course, depending on how long you live and when you start taking it, it returns you about 4%, which I think I can do better with my investments. I also, there's a saying, the first million is the hardest. I actually found that I agree with, because everything works in percentages. And so if you make 10% off of 10,000, well, you made $1,000, okay. But if you somehow got to $1 million and now you make 10%, now it's starting in absolute value, it's starting to add up a little bit. So once you get to that $1 million, after that, it goes up quite quickly. And then you also, once you kind of get into that class, you get other investing vehicles like the private equity I had mentioned that you can get into, which usually has fairly hefty minimums. And so you have to have a bit of a net worth before they'll even sell it to you legally. Not having a car, since I try not to buy depreciating assets, so that's a personal decision, but I think that's saved me a lot. Not only to pay even $20,000 for a decent used car, but the insurance, the gas, and anytime anything breaks, oh my God, just to see a mechanic, they charge you $500. While with my bikes, I can fix it myself or buy another one at a garage sale for $50. And if the bus breaks down, well, another one's going to be around in 10 minutes. So transit works for me. Of course, with not having a car, I think I gave up time, right? It's always time versus money, because it takes me longer to get places. And sometimes I wonder, if I had more time to myself by having a car, maybe I could, work more, work longer, who knows?
Do you think you'll ever get a car?
I'm not really seeing it.
Until you can't buy a bike anymore, right?
Well, you know what? In my biking group, the organizer is like in his 80s, and he's riding a bike, man. That's what keeps you healthy. When I was a kid, a quick story, we used to go blueberry picking out in Port Coquitlam, where it's all built up now, but there used to be blueberry fields. And this ancient farmer would lift 30, 40-pound boxes of blueberries, and he'd move them around and stuff like that. He kept the house, but either sold or leased out the blueberry fields, probably sold it. And within a year, he was dead.
Oh.
Maybe it was just his time. Maybe he didn't have anything to get up for in the morning. I don't know. But I think as long as you keep your body moving, whether you're walking, running, biking, whatever it is that you enjoy, I think that keeps, and of course, again, keeps your whole mind healthy as well. Exercise goes a long way towards keeping you healthy. Like I have no illusions of having huge muscles or anything like that, but I want to make sure my heart is healthy.
And it could be all the antioxidants, right?
Yeah. When the blackberries were growing in growing season, I picked a year's worth frozen and free antioxidants.
Yeah,
Ever check how much blackberries are in the store? It's crazy.
I buy it. You said a little tray for like $6. Yeah,
Exactly.
yeah.
Exactly. Like when I was picking them, I'm like, I'm making $100 an hour. My hands were a little stabbed, but
Yeah.
I'm like, ow, 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 stop stabbing me. So the car thing, that's obviously a very personal decision. Some people are like, you're crazy. And then if somebody lives downtown, they're like, yeah, I don't have a car either, but I'm out in Surrey and I somehow managed to trade time for money. The other thing that allowed me to kind of get to where I am, I think, is debt, good debt. Meaning not credit cards because I really needed that pair of jeans and I couldn't pay it off. I mean, borrowing to invest, mortgages on flips, having a home equity line of credit on my condo, and when the stocks tanked in March, emptying out that line of credit and buying stocks and watch them go up. I'm very comfortable with debt. I know what the risk is. I know I can always pay it off. And because I have dividend income, unless the whole world goes like this, I know at least some dividends are going to keep coming. And I can at least service the debt with the dividends. I can pay the interest on it. I've bought private equity, which paid 6%, and I borrowed at 3% to buy it. And I was perfectly comfortable with the spread. Plus, the private equity, for example, was giving me cash flow that was return of capital. So it would be later on would be taxed as capital gains, while the HELOC interest was fully tax deductible. So I even won on the taxes. The other thing with the debt is that I try not to, or up until now, I haven't had cash sitting around somewhere doing nothing or getting 1.5%. Is that I use the home equity line of credit as an emergency vehicle if I do need it. So that way I don't have, 3 to 6 months worth of cash sitting idle. Credit cards, you listen to Dave Ramsey, he's like, no credit cards, cut up your credit cards. I'm like, pay for them. Don't be an adult. Be an adult.
Yeah.
Don't be a child. And spend only what you know you can pay off, right? Have some self-control instead of having to carry cash around or write checks or whatever, or debit cards and having 20 transactions. You get to pay everything at the end of the month. You get one statement altogether. If you get any points, great. Don't spend money because of points. Spend money on stuff that you would have bought anyway, and just have the points as a bonus. I'm perfectly fine with credit cards. I think I have 3. I actively use 1.5, right? Some people have 10 of them. That's stupid.
Yeah, and the whole point of having 3 is because you get more points at a certain stalls, or when you're filling gas, you use a certain one, or is there another reason why you have 3?
Yeah, I have one which I don't really use anymore. I think that one has a whole bunch of insurance benefits, extended warranties, travel insurance, rental car insurance, that kind of thing. I have an Air Miles card, and then I have a cashback Tangerine card, which I got that one last. I sort of use the Air Miles card and the Tangerine sort of interchangeably. I know cash is better than Air Miles. So
you don't buy anyway, so why are you backing Air Miles?
Really, for Air Miles, the only thing I use them for is gift certificates to Starbucks, which is really the only thing I can use. And I think I can go to Staples and I can use my Air Miles card as a credit card. I can buy stuff at Staples directly with the Air Miles, I think. Staples is a little expensive, so I do check the flyer to see if there's anything that I actually want. The other thing is I do a lot of online surveys, and I've picked a survey site that pays you Air Miles. but like literally, like for 20 minutes of your time, they'll pay you $1. So I'm like, whoop-dee. But I like doing the online surveys anyway. So at least I'm getting Air Miles. And then, so last but not least is the emergency fund, 3 to 6 months worth of spending. As I said, up until now, I've been using the home equity line of credit as an emergency fund because I don't want money sitting idle, but that can be risky if you can't cover the interest. The odds of you being kicked out of your home and stuff like that are very slim. Like the bank doesn't want your home. So even if you can't pay the interest on a HELOC, the bank will work with you. Yeah, I wouldn't recommend using a HELOC to everybody. Be aware of what the dangers are.
So you mentioned the HELOC is at 3% usually?
Yeah, I'd have to look. I think it's around 3%, maybe 3.5%. I also have an unsecured line of credit, which I think is closer towards 4.5 or 5. I sort of have lines of credit all over the place, to be perfectly honest, because I think I mentioned I was financing a flip, and it just kept eating more and more money. So I started looking for money at all the different institutions. So this one says, oh, you can get a 20,000 line of credit here and 10 over here, and I think it all adds up to a significant number, but it's a pain in the butt otherwise.
I use a certain brokerage. I think I told you, Interactive Brokers, and then I use their margin. So their rate is like 1.85, and I can use like 100% margin. So they lend you like double your money because you have collateral under your stocks. So let's say if you have 100,000 with stocks with them, you can borrow 100,000 like straight up. No questions asked, nothing.
Okay.
And then you just return it, sell your stocks whenever, and then it'll rebalance itself. To me, that's really convenient.
That's actually really nice. Yeah, no, good for you. Q-Trade that I use on the margin account, like I always pay it off, but otherwise they would be charging around 5, maybe 4%. I don't think it's 5. I'd have to look. It's basically an unsecured line of credit. They sort of do use the stocks as collateral, but not at 100% rate, which so like Interactive Brokers, that's fascinating.
Yeah.
I think if the stock price is over a certain amount, they give you 70% credit. If it's between here and here, they give you 50%.
And it depends on the grade of your stock. If you're doing like penny stocks or wheat stocks, you don't get as much. If you're doing like blue chippers, you get like 70, 80%. Yeah.
Oh, but you said 100%. So
I'll actually get more than 100%. I can go 3x actually.
Oh.
For them, it depends on the grade of the stock. But for some of my other brokerages, I get like 50% from like wheat stocks or an 80% for blue chippers.
Okay. Yeah.
Not that I ever had wheat stocks, but something in that category.
Actually, I had a put which that I sold, and it was the strike price was $6. And today, a wheat stock was at $5.99, and today was the expiry date. So on Monday, I'm going to be the proud owner of Afria, which I think I'm immediately going to sell a covered call on to see if I can get rid of it.
Yeah, on the green day though, so you get more premiums. But you can tank on Monday. Who knows?
Yeah, sure. Yeah. Well, I don't know. Maybe they've been beaten up enough and they'll turn it around. But okay, that's. I think any other generic advice or anything else you want to mention to our viewing audience?
Don't listen to everything you hear. like there are a lot of intentions behind people selling courses for $500,000, but they show you these proof that they can get 10x stocks, which is ridiculous. Like if they can find these 10x stocks consistently, they would just keep it to themselves and leverage the hell out of it and get billions. They would never just sell you a course on how to find these stocks. But you see 1,000+ students in their courses. It's just how people are sold. Like they just trust people based on like either the number of subscribers or how many videos they make. It's just how, I don't know how this scam works. To me, it's a scam because they're claiming they can get 10x stocks, which nobody can. And they're just doing it outright. They're not saying, no, you might. And there's so many more. Like get rich fast schemes is just getting rich for them. Like that's the goal. It's not getting you rich, it's getting themselves rich. We need to be able to like vet like what kind of facts people are telling you. Like that's a learning process because by default we trust people either with like some kind of designation or some kind of social proof. They have $1 million account, then therefore we trust them. But it's not the case because they can start out with 2 million and then they end up with $1 million account. So how good is that, right? Like they show you what sells you. That's the ultimate gain for them.
I think everybody who's successful, they try to get another source of income by selling books or selling courses or what have you. The odds of you being as successful as they are just because they teach you aren't great, because that person could be smarter or they could just have something that you don't have. And it doesn't matter how much mentoring, even one-on-one, you can get. You're still not going to get the same success as that person does. I'm very suspicious of companies that sell courses, because if they had a foolproof method of making money, why would they share it? Just why? Why would they? They would set up an office, get 2, 3 floors,
Exactly.
get 300 traders, all trading using this proven method and making them money. They wouldn't have to charge, $3,000 for a week-long course and do advertising and do kind of demo courses where it's a free course and it's just enough to get you interested to buy the real stuff. And then once you do the first course, then there's a second and third course, and eventually you spend $15,000 and you haven't made a single dollar, and you may not.
Yes. And you won't know until you've done all these courses.
Yeah.
So that's
Yeah. And then it's like, well, can I get my money back? Well, no. So there's no guarantees, right? Like with day traders, the statistics are horrible. Like 80 to 90% of day traders actually end up losing money.
Of course.
For whatever reason, whether it's because they don't stick to the plan, they double down, and it's like, okay, the stock's going down, I'm going to buy some more, and then it just keeps going down. In the long run, you have a chance of it going up, but not when you have to sell in the next 2 hours. It's tough. People have always been attracted to get rich quick schemes, I think, because why wait for years, or why work hard for something if, hey, you're special, you can do it.
Yeah, you can do it. So we have the formula. Just follow.
Yeah. And there's always going to be somebody to sell that formula to you. And unfortunately, I would suggest people educate themselves by reading, by watching YouTube.
There are good ones, yeah.
Good ones out there.
You need that filter.
Yeah, but maybe right now, at least we're not trying to sell courses, so we're trying to educate, and because we have it as a passion. So in any case, I think we've covered everything under the sun. I'm Alesh Eisner of Canadian Money Talk. This is Rob of the Mindful Investor, and we thank you for your attention. If you are still with us, we will put up more videos on a frequent basis. So we'll hope that you'll join us. Thank you, and goodbye.
Goodbye.